So we are going to go into chapter 14, where we are learning about how firms raise equity capital. Most firms start their journey by being an all-equity firm. An entrepreneur comes up with a bright idea. They maybe invest their own capital or raise a few dollars from their friends and families and start an enterprise, start a business. As the business begins to take over and become successful, take off and become successful, they think about expanding the business. So they need a little bit more capital. Usually they'll have a hard time getting debt capital because they don't have enough track record, they do not have enough assets to be collateralized against the debt. So they will turn to equity capital, and there are different forms of equity capital that they can turn to, usually starting with angel investors, venture capitalists, and so on and so forth, until they get to a point after several years of success and track record and building up the business and creating some steady stream of cash flows, creating excitement about the product, they may be ready to go what we call public. Now they can solicit money from the general public and raise lots of money to expand the business further. So in this chapter, we learn about what is the process of raising equity capital. It is mostly a descriptive chapter, a few quantitative things about what happens when company raises capital, what happens to the value of their shares, what happens to the proportional ownership of the people who are in the company, who are already invested in the company, either as founders or as shareholders, what happens to their holdings, so on and so forth. But before we start the whole chapter and look at the whole sources of funding, and these are the general sequence. You start with angel investing, which is essentially people who are willing to risk their capital, give you money, small sums of money. Of course, generally very wealthy investors giving you small sums of money, but they're taking enormous risks with exit strategies. You have to tell them at what point you're going to essentially return their investments back with some profit. They're not expecting a guarantee. That's why it's equity capital. They're not guaranteed that they'll be paid back, but they're expecting their capital back. Then we go into venture capital, which is similar to angel investors, but venture capitalist firms may also provide some expertise, some business expertise to help the company move along. And then institutional investors, more directly investing from pension funds and others, corporate investors, and then finally going public. So what we want to talk about mostly is the going public process, what we call the initial public offering or IPO. And to start with, we're going to watch a short video that outlines for us what the IPO process is, but also alludes to this part and to the corporate investor part, how a firm went on a journey. The video is about a company that no longer exists, it's Netscape, which was one of the first graphical browsers. Now we think about Google and we think about Chrome and we think about Internet Explorer, maybe Firefox. Netscape eventually became part of Firefox. But Netscape was the first company that attempted to graphically look at the internet. It was a small firm compared to Microsoft and others, and how they brought their product, not just their product to market, that's not what we're interested in. What we're interested in, how did they raise the capital to expand their business? What is the process they engaged in to expand their business? So let's learn a little bit about Netscape.
I'd like to say that where we are with the net right now is like 10 milliseconds after the Big Bang.
There's no question that people in the future, if we continue to evolve as an industrial society, will be able to communicate in ways that we find hard to imagine today. On different planets at different times, maybe having communication between people who are in different centuries, right? But it would have the same friendliness as you and I sitting here talking. I mean, it would have that much interplay or interaction as we can have here. But it's done in an asynchronous environment. Well, that's opportunity because we're nowhere close to that yet.
The concept of computer networks has been around now for 10 or 20 years. But it's only been in the last few years that any two networks can be connected together. Up to a couple of years ago, most business networks were isolated islands. It is all of a sudden very easy to take a large number of all kinds of different types of systems and tie them together.
Basically, there is a paradigm shift going on. It's already happened.
So the first laws of physics are pretty clear, but we have no idea what the universe is going to explode like.
There's this guy, Jim Clark. He's the guy who founded Silicon Graphics. And Jim Clark leaves and starts his own company. And everybody's kind of wondering, well, what's Jim going to do? At the same time, there's Mark Andreessen working over at University of Illinois, Champaign-Urbana. He's making $6.85 an hour. He's working with a bunch of guys on this piece of software that is the first graphical way to look at information that's on the internet. Well, Mark and his buddies are starting to get mad at the university. They feel like the university is trying to take control of the project, and so Mark meets up with Jim.
Jim said, I've got it. You got to meet this guy, Mark Andreessen, who was, at the time, 23 years old. And Jim sent Mark over to see me. He sat down in the corner of my office and said, I've got some software that's going to change the world.
The good thing about a software business is it doesn't take a lot of front-end capital. We had a great venture capitalist, though, John Doerr's company, Kleiner Perkins, because not so much the money they put in, but because of John Doerr himself. He's been in a number of startups. He has great instincts, great feel for these things, and can give marvelous advice.
The business of competing in this new information economy is, in my view, all about building great teams and picking large, rapidly growing markets where you're going into that market can make an order of magnitude change.
Then they hired Jim Barks, and I was like, wait, maybe this company's for real. They've got a guy who's got a real track record at huge publicly traded companies. He's done incredible things. He's worked for Federal Express, he's worked for Macaw, he's worked for AT&T. And so there's this idea, maybe he's gonna make Netscape into something real big.
I remember being stunned when Jim Clark came in and reported he'd leased, I think, 200,000 square foot buildings. It was the talk of the valley. What was Jim going to do with all these buildings? We blew through that space in about 100 days. Netscape thought big from the beginning. They executed big, and they had the best product.
By the time we got to our product release of our first commercial product, which was only 8 months after the business was incorporated, and we knew we had something going, I said, let's you know, let her rip. Because the worst thing we could do at that time was get so scared we were going to run out of money that we would have inhibited the opportunity and the growth.
In April of '94, they do their first round of private financing. And they sell 4 million shares at 75 cents each. They raised $3 million. That's followed by the second round of financing, and then finally a third round of private placement in April of 1995. They raised $36 million.
We brought in these people that were our partners, users of our products in the publishing and communications business, people like TCI, people like Knight Ridder and Hearst Corporation and IDC and people like that. So that was as much getting them involved in the business as it was raising money.
So these are all media companies, and between them they pitched in about $36 million in exchange for shares.
We demonstrated that now large enterprises were, in an era of declining IT budgets, prepared to pay millions and millions of dollars to bring up sites like the Federal Express website or the CSX kind of site. So each step along the way, we were really honest about where the risks were. We had an incredible sense of urgency about getting them done, and the company was made more valuable.
And so Bill Gates writes this memo that was called the Internet Tidal Wave. It's an internal memo, and it basically says, this is a big deal, guys, and we got to get on board, and we got to get on board fast. And what we've got to do is we've got to build the internet into all of our products. And just the fact that Microsoft did feel so threatened showed a lot of people who didn't think so already that Netscape was onto something really big.
We'd established a brand. We knew we had a real business. We were actually selling the product at a nice rate, and we were cash flow positive. And then a couple of guys with what we thought were lesser businesses than ours went public. Clark and I and Dora and others said, gee, if they can do that, we can do that. And our underwriters said, yeah, we can.
Initial public offering is when you decide that the company's ready. It's mature enough, its performance is predictable enough that you can bring individual and institutional investors who may not be as sophisticated as private investors, are not as willing to just lose their money, in as owners of the enterprise. It's really important that you do that.
One, it's a good, inexpensive way to raise money. But two, it takes public your employees' shares, which gives them a value so that it keeps employees motivated and focused on building value in the business. And it allows you to actually pay a lower cash compensation for some of these marvelously bright people if they're willing to take some equity upside potential. So it's a way of not only financing the business, it's a way of attracting and keeping a great employee base in a company growing as fast as Netscape.
The IPO environment when Netscape went public was very good. The calendar of deals waiting to go public was filling up. IPOs were going up 25% routinely on the first day, and they were doubling in price over 6 months.
The traditional role of the underwriter is to take risk. In other words, at the end of the day, what literally happens is you, the company, issue a pile of stock certificates to the investment bank, and they hand you a check. That's the transaction that the company enters into. The underwriter is the wholesaler and then distributes those securities and offloads them to either their distribution channel, i.e. the other investment banks in the syndicate, or end buyers. And they capture, if you're selling stock for $100, then they'll write you a check for 95, and they're obviously trying to keep the 5, and that's how they make their living. And while they're certainly taking an underwriting risk, they're going to try to minimize their market risk. So they're going to walk you through as long a marketing period as you can stand. By the end of 2.5 weeks on a worldwide roadshow of a dozen presentations a day, I mean, you feel like a trained SEAL. I think we were in Delaware going to Philadelphia for our last meeting. When we actually had to pull over and price the deal, I was on a payphone in Denny's calling into a call-in number set up by our investment bankers. Barksdale was across the street at an Exxon station.
They went from $14 to a few days before they actually were going to start trading, they priced at twice that, $28. And at the time, that was the only time that had ever happened. No one had ever found that demand was so great that they could double their price, and that was huge.
A lot of people thought, well, 28 bucks a share. I mean, geez, the company hadn't had any net income. They hadn't had profits. They'd only had losses. Who were they? I mean, their main technology guy is some 20-something that who's never had a job before. He's sleeping through early morning meetings and showing up late. I mean, who do these people think they are?
We priced it certainly quite a bit higher than the high end of the initial filing range. We had increased the size of the offering. None of us truly knew what the value was.
Well, so Netscape goes out. It's supposed to go out at 28. They open at 71. They've got a total of 38.1 million shares at the time. So that gives them a market cap right out of the box, $2.7 billion. $2.7 billion. I mean, there are companies that have labored for, tens of years to get market caps that were $2.7 billion. And Netscape gets this in, basically 1 minute. 1 minute. An hour and a half later, shares are up to 75. Now they're worth $2.9 billion market cap.
Arguably, you could say that we, the company, made a mistake by accepting a price which turned out to be so much lower than the initial opening of the market. The stock, on the other hand, did settle down from that lofty level. And, frankly, you have to make a decision and go with it. We made the decision.
By the end of the day, it closed at about $58, which was still a heck of a ride for a stock by any measures.
We all just stood back in amazement, and then we got back to work.
By the end of August, their shares are back down to $49.50, which gives them a market cap of $1.9 billion. So see, they've gone from $2.7 billion the first minute to $2.9 billion the first hour and a half to $1.9 billion at the end of the month. Just amazing. End of the year, their shares have traded way up. They're up at $5.9 billion. And for the end of the year, they've had a loss of $3.4 million.
But this is a market that's estimated to be a $10 billion market by the year 2000 for software alone, of which if we get 30 to 50%, that's a very, very large software company.
I'm not sure what an internet multiple is supposed to be. Maybe nobody knows yet because they're so all over the place. But, a lot of companies trade, say, 20s, 30s, 40s. So Netscape, the multiple was 190. That's like way out of whack compared to what they've earned.
But our stock value is very important as a currency for acquisitions because one of the primary ways we grow in an industry moving this fast is to go out and acquire other companies.
Our mission is to grow the market, capture as big a share of the market as we possibly can, broaden our product line, really to create a company with real staying power and real opportunities.
I mean, if you look at it in context, Netscape's net income, for any given quarter is basically a rounding error on Microsoft's earnings sheet. I mean, they're nothing.
I don't want to portray the business as being easy. From 7 in the morning until 10 at night, you're desperately trying to go after markets where there's larger entrenched competitors who are just about to kill you.
Part of what makes Netscape such a great story for us is that you have all these software companies out here who are feeling really, really threatened by Microsoft. So what happens is all these companies suddenly see Netscape as a way, hey, we can write our software for Netscape. And that way, we're not stuck just writing it for the big bully.
If you don't have any competitors, you must not be in a very good business. All honey draws flies. But if you ask me, do I think that there's long-term a very bullish opportunity for companies like Netscape? I absolutely think there is. We have an insatiable desire as human beings to communicate, but we all know that there are better and better ways to communicate. So companies that can participate in that evolution are going to profit by it.
What investors who are buying the shares now are looking at is, they're not looking backward, they're not looking at what they've earned, they're looking forward. They're looking at what they think will happen. They're thinking, maybe this will be another Microsoft.
So that gives you a snapshot, a quick look into how an IPO is done. With that as background, we will continue a little bit now into the chapter itself. So when we look at the first type of investing group, when they start off as an entrepreneurship before they get into IPO, initial public offering, they will reach out, businesses will reach out to a group called angel investors that are generally individuals, wealthy individuals, who buy equity in small private firms. So at this point, the firm or the corporation that is raising money is still a private company, but they're reaching out to some wealthy individuals to come in as angel investors. And this is the first round of financing that is generally done through angel investing. Then we go on to venture capitalists when the firm grows a little bit bigger, a little bit more stable, a little bit has more business history. Then they will reach out to venture capitalist firms. Now, these are specialized businesses. Their job is to specialize in raising money by providing private equity to young firms. Venture capitalists often demand control because in addition to providing capital, they're also providing some business expertise, and because of that, they do demand some degree of control over the firm's decision making. So if you look at the most active venture capitalist firms and look at how many deals they have completed, that gives you some list. Some of the one company that you saw in that Netscape video, that's this Kleiner Perkins company, which is one of the larger venture capitalist IPO firms out in the market that specializes in technology type companies. This gives you a look into how venture capital funding has varied over the years. 2000 was a banner year. That was at the peak of the dot-com era, and since then it has subsided, but still remains quite robust and stable in terms of the dollar amount of deals that are going in. A pretty robust market, $40-50 billion of business per year. It's a healthy sized market. Then after the firm continues to remain successful, they may reach out to what we call institutional investors, particularly pension funds and insurance companies and university endowments and foundations, who may directly invest in a firm. And that direct investment is usually just capital investment, not so much investment like venture capitalist, which is looking for some degree of control. Sometimes they bring in corporate investors, like we saw in the Netscape story. They brought in businesses that they were partnering with for their product. They also brought them in as corporate partners, strategic partners, or strategic investors, which provide, again, not only capital, but also some level of expertise and market understanding for the company. After all of that is done, then the company may decide to sell equity to outside investors for the first time. And this is usually done through common stock, but it is often done by issuing preferred stock first, and then at a later stage, converting those preferred stock into common stock. So here is an example of such a process. You initially contribute $100,000 of your own money into an enterprise that you started, and you gave yourself 1.5 million shares for the $100,000 that you invested. Since then, you sold an additional 500,000 shares to angel investors, and now you are considering going out and getting capital from VC firms, venture capitalist firms. The VC firm has decided that they would invest $6 million, and they would like to receive 3 million shares for the $6 million that they have provided to you. The question is, what is the post-money valuation of the firm now? Assuming that this is the VC's first investment in your company, what percentage of the firm will she end up owning, and what percentage will you own, and what is the value of your shares? These are all important questions. You're bringing in external stakeholders into the firm, and you want to find out how much is their investment worth, what does it do to the value of your firm, what does it do to the proportional ownership of your firm, so on and so forth. So if you look at, you initially owned 1.5 million shares, then you provided 500,000 shares to angel investors, and this 3 million shares to the venture capitalist. So the total number of shares outstanding now, after the venture capitalist round of funding, is 5 million shares. The VC firm is paying you $6 million, and in exchange they're receiving 3 million shares, so that automatically prices the new shares at $2 per share. So at $2 per share, that is the new share price, because that's the transaction that happened last. for a total number of 5 million shares outstanding gives you the total value of the firm at $10 million. 5 million multiplied by, this should be multiplied by $2 per share, gives you $10 million. Now, because the venture capitalist is buying 3 million shares, and there are total 5 million shares outstanding, which means that the venture capitalist's ownership of the firm is 60%. And since you have 1.5 million shares out of a total of 5 million shares outstanding, that means your ownership of the firm is 30%, and the remaining 10% is for the angel investor. What is the post-valuation of your shares, post-money valuation of your shares? You own 5 million shares at $2 a piece. That means the value of your holding is $3 million. Okay, so that's how we do post-money valuation for venture capital and angel investing companies. A similar problem over here, and you can work this on your own. Review this. We'll give you a similar type of exercise. So at some point, either the angel investor or the venture capitalist would like to exit their investment. And their exit is one of two ways. Either your firm that they have invested in is acquired by another firm, which pays them a return for that investment, and then they take that money and they leave the firm, or, which is more often the case, the firm goes public, IPO, initial public offering. Initial meaning right now, the first public offering, and the shares that are sold through the IPO, they hope to receive a public value, and then the venture capitalist or the angel investor that is holding on to their shares will then sell their shares in the public, and that's how they will recover their investment that they have made. So the process of selling stock, equity, to the public for the very first time is called an initial public offering. Here are some of the largest global IPOs, and you can see the staggering size of some of these IPOs. $19 billion, Facebook over here, $16 billion, GM, $15 billion, Kraft Food over here, $8.6 billion, and so on and so forth. These are large deals, and you can see a couple of things. You look at the company name, when was this done, where was this firm IPO, which stock exchange was they selling? For example, Kraft Food at NYSE. These are American companies. General Motors, Facebook will be NYSE. But notice, Facebook is on NASDAQ, not NYSE. And then when you look at international companies, for example, British Gas PLC, they're trading, they're IPO'd at the London Stock Exchange, and so on and so forth. In addition to this, an interesting thing that you note over here is something called the underwriter. The underwriter, as you noted in that Netscape story, is the business entity, like Kleiner Perkins in the case of Netscape, that is coming in to provide expertise. And also financial help in terms of bringing the capital, bringing the firm to the public. Sometimes they buy the stock from the company and they sell it to the public. Sometimes they simply help the company sell the stock directly to the public. So they provide a variety of services from market expertise to capital help. There are advantages and disadvantages of going public. Of course, the first advantage is that it gives company shareholders greater liquidity. When you started this firm, let's say you had that 1.5 million shares that you gave yourself for the $100,000 that you invested. But how do you recover, how do you cash in on your investment? If the stock is not trading publicly, then you have to literally find buyers for your shares. But if the stock is trading publicly, then you can simply go to a public exchange and sell your shares. So that provides, that's what we mean by greater liquidity of shares. This allows more people to participate in investing in your company. Liquidity helps your employees who may have come into your company with low salary but with some ownership in the company owning some stock in the company, it helps them receive a value for their investment. And IPOs thus give you better access to capital. Right? Now you have a bigger pool of investors available to you from whom you are raising that capital. So that gives you an advantage. The disadvantage is that equity holders are more dispersed. As the owner of the company, your proportional ownership went from the initial 100% down to 30% in the example that we saw. And perhaps most importantly, you must now satisfy all the requirements and regulation. Requirements essentially are regulations for public companies, from filing regulations to reporting regulations to other kinds of disclosure that the law requires you to make as a company. IPOs include both primary and secondary offering, meaning that is the first time, and then you can also come back to the market a second time or a third time. So we sometimes call them secondary equity offerings. So IPOs are in the primary market, and in the secondary market we call them SEOs, secondary equity offerings. They're usually done through an underwriting syndicate, the underwriter providing expertise, as we saw, and in this case, the first underwriter is the lead underwriter, but then they quickly establish a syndicate, a group of other underwriters that help to market and sell the issue. So this way, the risk of that issue is spread among many underwriters. So one underwriter does not assume excessive risk. It is spread among many underwriters, and this way they are able to market and better market the issue. You can see some of the major underwriters in the US market. This is for reporting period 2012. And you can see they're pretty large. $13 billion in capital in proceeds from 78 issues, Morgan Stanley owning 8.9% of the market, and so on and so forth. So we will stop over here and continue next class, taking a deeper dive into how the process of underwriting actually works.